A mortgage is a loan acquired from a financial institution to buy a real estate or to buy a property. And you may ask, what is a real estate? A real estate is anything, could be land or a building or land and improvements thereon. So basically, when you're able to define or be able to go into deeper details, a mortgage is a loan acquired from a financial institution for a specified period of time. And for this specified period of time, the property is held in the financial institution. That's when you say that a property is charged to the bank, because the bank is going to hold the property for the defined period that you have chosen as a customer. So you find that most of the mortgages are long-term facilities. Well, a normal loan could be a personal loan, could be an asset finance. These other facilities or these other loans are acquired for a very short time. Well, for a mortgage is acquired for a longer time. Well, for a mortgage, you have to be able to provide a security. And this security is the property that you are buying or the property that you could already own. For most financial institutions, they'll be able to finance your property as long as it's within the urban areas, or it could be within the county headquarters, what is formerly known as municipalities. So if we're able to go deeper into get to know what is a mortgage, basically it's a mortgage is a loan taken from a financial institution that you as a customer you take from a financial institution to be able to buy a property that you prefer or that suits your taste and preferences. We have two different types of mortgages, the fixed and the adjustable rate mortgage. The fixed mortgage rate is whereby the rate is fixed for a specific period of time, and you as a customer you'll be able to pay that rate for the term that you have chosen. For instance, if I take a mortgage at a rate of 10%, this rate will be fixed for these 10 years, and as a customer I'll be required to pay the same repayment for the 10 years time. Well, the adjustable rate mortgage is what is commonly known as reducing balance. It's usually say it's a reducing balance rate, and the reason why it's a reducing balance rate is because you as a customer you pay the interest at the initial years, you pay more of interest, less of the principal, and as you're about to clear your mortgage you pay more of your principal, less the rate. So you find that the interest and the principal keeps on oscillating at different times, and also depends on the term of the time that you've taken. Choosing a rate mortgage can be a daunting task for you. Reason being, a mortgage sometimes tends to be a complex product because many people do not understand where to start. However, at HFC, we're able to work with our customers at every journey. And as you choose the right mortgage that you want to be able to take, one, you need to be able to understand your budget. Your budget? You also need to be able to understand the location of the property that you want to buy. Where do you want to live? And the other thing that you also need to be able to consider, it's important to be able to consider your income as you're choosing the type of mortgage that you want to be able to choose, or from which financial institution that you want to be able to apply. So what we do at HFC, for one, at HFC we're able to demystify or to make the mortgage journey easier by having relationship managers who are able to work with our customers at every stage. You find that a mortgage has several stages, and out of all these stages we're able to advise the customer and be able to hold them, to be able to guide them, to be able to guide you as our customer on the best process, the best stage, or the best product that you need to be able to take if you are starting out. As well as also at HFC, to be able to make your process easier, we provide properties, so whereby we're able to say that it's a one-stop solution, and a customer can be able to come in at HFC and to select a property, and we're able to finance. In the past, I've had instances whereby people say that they would rather take short-term facilities to be able to acquire a property of their dream. But for me, I find this very limiting, because a property, when you're buying a property, is the most expensive investment that you'll ever make in life. And since it's the most expensive investment you'll ever make in life, if you found a property that suits your taste and preference, then that's when we recommend a mortgage to be able to check in. And why do we say so? A property valued for 10 million today will not be valued for 10 million in 20 years' time. Properties appreciate in value on year-on-year basis. Hence the reason why we recommend customers, or we recommend you to be able to take up a mortgage, and this saves you on the time value of money. The other thing that we recommend about taking a mortgage, you find that once you acquire your first mortgage or your first property, it helps you to build up on your capital or your leverage, and you are able to acquire even a top-up facilities to acquire or to buy a second and a third property. So the first mortgage that you ever take builds up your capacity to be able to buy a second, a third, and a fourth property through a mortgage. There's a perception in the Kenyan market that mortgage is suitable only for employed persons, but that is not true, because as long as you have reliable or consistent income, at HFC we'll be able to finance you. For instance, you could be in employment, you could be self-employed, you could be in consultancy, you could be on contract basis. Also, you could be having other sources of income, like whereby I have a block of apartments and you have some rental income. We can be able to use that rental income and analyze or appraise you for a facility that you are looking for. So for that, I may say, as long as you have a consistent, reliable income, you qualify for a mortgage. It's a six to seven stage process, and this depends on where you are as a customer. First, you might have found your property that suits your budget or that suits your taste and preferences, and for this we'll be able to support you to be able to advance with the facility that you are looking for. Or you could be looking for a property, and at HFC we have a one-stop shop whereby we support our customers to be able to get the property that suits their budget. And these properties are located within Nairobi and its environs, as well as other counties. So I may say at HFC we support our customers to be able to walk through the mortgage journey, which sometimes seems to be complicated. However, our relationship managers are well versed, and they're able to demystify, they're able to equip as well as also empowering our customers to make the mortgage journey easier and lighter. So for once you have found your property, then you're able to submit your income documents. And some of the income documents, you could be either employed, or your bank statements, as well as your pay slips. If you're in the diaspora, also you also look at our customers, and something good for our diaspora customers, we're able to finance our diaspora customers up to a term of 20 years. And this now helps us to be able to relieve or to be able to cushion them, to cushion you as our customer on your income, on the income that you already have, or as well as on your income. So once you have found a property, you submit your income documents as well as the property documents. The next stage is an approval stage, whereby we are able to approve the facility and issue an offer letter. At an offer letter stage, you are required to be able to, you as a customer, to be able to accept the offer letter and return to the offer letter to the bank. We usually require our customers to be able to accept within the shortest time possible, so as also we can be able to fast track the mortgage process. You know that the mortgage process takes approximately 90 days, and out of these 90 days, we try our level best to be able to work within this stipulated time, so as also as our customer can be able to realize the dream of moving into your house or getting into your property. So I've said, once you have accepted the offer letter, we progress to valuation of the property. The reason why we need to be able to value the property is to be able to ascertain what's the value, the value of the property, as well to get to know the purchase price or the value of the property, as well as also getting to know the location of this property, and understanding there are any encumbrances on this property. What do I mean by encumbrances? Meaning by encumbrances is that there is no one who holds any secondary rights of the property. So for this, it also helps our customers to be able to cushion them in the sense that we are able to carry out a due diligence of the property. One of the things that we've noted in the Kenyan market, when you're buying a property, it's important to be able to do a search of this property. So having done the initial search, and now you're doing a second search, that is done by our professionals, but the panel of valuers that we work with enables you to be able to be comfortable of the property that you are buying and to know that it is safe and there is no one who owns the secondary rights of the property. So once we have done with the valuation of the property, we progress to the next stage of ensuring that the property is registered in your name and it's also charged to the bank. And I'll explain when it comes to charging of the property is whereby the property is held in a bank for a certain period of time. So once you are done with the legal process, then the final stage is the disbursement, whereby we're able to release the money to the vendor or to the person selling the property. And within that, then we ensure that we've been able to work within the 90 days and you're able to get your keys and move in to your house. When buying a property, you find that there are other costs that are stipulated in the property transaction, and these costs they usually range in between 6 to 8%. So it's important for you to be able to have some of these costs in advance to avoid instances whereby you're able to delay the property purchase transaction or even the mortgage transaction. Besides the deposit that is required by the developer, there is now this other 6 to 8%, which are stamp duty. There's a stamp duty that is paid to the government that ranges in between 4% to 2%, as well as we also have the legal fees. Remember that we need to be able to charge the property to the bank, and there's also the further due diligence that needs to be done. Hence the reason why the lawyers come in and to ensure also that the property does not have any encumbrances. The other cost that come in with the property purchase is evaluation, to be able to determine what's the value of the property. Then we also have other costs that you need to be aware of. If you are taking up a mortgage, you have the insurances, and this is one. We have the life insurance, whereby we ensure that our customer who takes up a mortgage, you as our customer who takes up a mortgage, you are insured to avoid instances of death or incapacitation where the property or where the mortgage is passed over to the next of kin. So from this, then we also ensure that our customers are covered, as well as also we have the domestic cover, whereby the property is covered to avoid instances in case of fire or burglary. The property is insured. So those are some of the costs, and it's important when you're buying a property to be able to know that the other costs that come in with the property purchase, besides the 10% to 20% deposit that you're going to pay to the developer or to the person selling the property.